This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning John Rubino, well-known author and publisher of the website $collapse.com. Good morning, John, and welcome back to Macro Analytics.
Good morning, Gord. Thanks for having me on.
We now continue with Global Imbalances Part 2, already in session. And I'm always grappling with solutions for this and the degree of the problem. And one of the things I watch very closely, John, is the Bank of International Settlement in Basel, with a central bank to the central banks around the world, and the research and their thinking. And they recently had a major paper out that isolated, in their mind, the specific drivers of the global imbalances. And I thought it's really telling to listen to them as they're looking at, therefore, what the solutions are, whether they're right or wrong, because, they actually had a 1-week conference and brought the best minds in the world in as they tore it down. But what they isolated as the specific drivers of this were twofold. One, and I don't think there's any surprise to anybody, regional growth differentials that we can see, and then the capacity to generate financial assets from real investments, which is an interesting and a very telling way of really describing a lot of our problems. And I could get into a whole discussion on Europe right now on that. But from that, then they said that in turn, these were causing the key effects of one, U.S. currency account deficit, declining long-term real rates that we're seeing with the treasuries, and a rise in the share of U.S. assets in global portfolios. And we get into the whole discussion of collateral contagion that's going on as there's becoming fewer and fewer viable assets, and especially if these portfolios are U.S. assets in their portfolios that are denominated in U.S. dollars. And this in turn, they argued and proved very, very analytically from a lot of the research papers, this in turn was then resulting in the more visible trade imbalances, current account deficits, and balance of payment issues that we're seeing. Comments on any of that?
Yeah. I mean, I think that accords with what we've talked about. That there's a buildup of U.S. denominated assets out there, and there's not the perception that there's much else to invest in anymore. That and German bunds, and that's almost it. And
you now pay them not just for the bund, but
now it's negative 0.05% on a lot of these things, and so we're reaching the point where capital preservation has become the main strategy, and income is really secondary because you can't generate even reasonably safe income anymore on any kind of a scale. You make 1 or 2% on a bond portfolio and you're doing okay. And,
in nominal terms.
Yeah, in nominal terms.
In real terms, we both know you're underwater.
Yeah. Especially if you use honest inflation accounting. And so for a pension fund.
John, even if you use dishonest inflation numbers such as the CPI, you're still negative right now.
That's true.
So even the crooks have to acknowledge it.
Yeah, but with the honest numbers, you're negative 3 or 4 or 5% a year, which is disaster. If you're trying to run a pension fund.
John Williams argues it's 10.2, and growth of 2%. So somewhere in the negative 8% kind of yield, and that's if you believe the GDP, and that's another discussion on how those are calculated. So,
see, this actually leads to one of the hidden imbalances out there that's building up, and that is in pension funds, because the average pension fund now is assuming a return of 6 or 7 or 8% in order to be fully funded going forward. But how do you generate that kind of a return if the average treasury bond is 2%? And that's your best asset. So the alternative is to accept a much lower rate of return and become more and more underfunded over time, or to stretch, to invest in hedge funds and junk bonds and really aggressive stuff, which eventually will cost you even more out there and make you even more underfunded. So at some point, we're going to have to recognize that the major pension funds of the world are in such a deep hole that we're going to have to come up with trillions of dollars to make them whole again, or everybody's benefits are going to have to be cut dramatically, which means we're far less rich than we thought we were, even though we don't feel that rich right now. A lot of people at least think, well, okay, I've got my pension. I don't have a house or a good current income, but at least when I turn 65 or 62 or whatever, I've got this pension. Well, you're not going to have that pension either. You're not going to have lifetime health care, and you're not going to have 95% of your final salary for life. No, those things are going to evaporate at some point. And we haven't hit that point yet. We're getting there with some state and local governments in the U.S., but it hasn't become an across the board phenomenon yet. And that's going to be something that's new and shocking to people when it comes, and it's just going to add to the global sense that this is the end of an era, and the middle class life that we all thought we were entitled to is evaporating.
It goes without saying, the National Center for Policy Analysis had a study out just this last week, and it showed that the real U.S. debt is actually $83.4 trillion, and the biggest part of it is unfunded liabilities. And it's in the pensions, whether government's already committed or newer ones coming. And there was $53 trillion associated with remaining unfunded obligations in building up this 84 trillion. And I would argue that's just the United States. It's much worse in Europe. And especially if Holland, the new president, reduces the retirement age to 60 years in France, as things even get much worse. What are the problems these imbalances are causing? A lot of our listeners would say, okay, we have these imbalances, it's not good, but what on a day-to-day basis is it making a difference to people in their lives?
It's a different problem for different countries depending on what kind of an imbalance they build up. For the exporting countries, they've made what could potentially be horrendously bad investments with the income that they generated from their exports in the last couple of decades. So they feel rich right now because they're able to export a lot to the rest of the world and get dollars and euros and yen in return. And they feel rich because they've got these big balances of, like a big savings account in their central banks. Well, if those two things evaporate simultaneously, which they will if these imbalances have to be reversed out, then all of a sudden they're a lot less rich. They have fewer people working, they have more political instability, and they just generally aren't the rich powerhouse countries they thought they were. The other side of the ledger is the countries that have built up huge debts in order to import stuff. Well, that debt is slowing down the economic growth in all of these countries. The U.S. is generating 1 or 2% a year in new GDP each year, even by our fraudulent accounting standards. Or at least mainstream economists are confused by this because, low interest rates and quantitative easing and recent tax cuts should be, giving us 4 or 5% growth every year. Well, and what they seem to be missing is that when you borrow a whole bunch of money, then the debt service siphons money away from what would have been productive uses. And so we have to pay off our debts year after year, and that slows down the economy. People can't borrow anymore because they've already maxed out their credit cards. Therefore, they can't buy stuff, and they have to pay interest on their credit cards and their mortgages and their car loans. And so they can't use that money to buy stuff. So consumer demand is lower than it would be otherwise, and state and local governments aren't taking in the tax revenue they would have been otherwise, and they're having to lay people off. So you get dramatically slower growth, and that's the precursor to some sort of a systemic collapse. Greece and Spain are the future for the UK and the US because we've made the same mistakes they've made. They have more immediate problems because they're having to live under a relatively stringent monetary policy that's dictated by Germany. And so they can't just devalue their currencies. So they're being hit by their imbalances today. But the same thing is out there for us in the near future because, we can't keep a dramatically loose monetary policy going on for much longer People realize that the pound sterling and the US dollar are being inflated away, and they aren't going to want to own dollar and sterling denominated bonds anymore. That'll force interest rates up, which will be basically what's happening to Spain and Italy and Ireland and Greece right now. And our debt service costs will soar, and we'll enter a kind of debt spiral where rising debt service costs increase our deficit, which requires us to borrow even more, which will push up our interest rates even more because it'll scare the markets. And there's no end to that. There's no fix, because you can't print your way out of that kind of a death spiral. All you can do is ride your currency down to zero, accept either a hyperinflation on the way and then a catastrophic collapse at the end, or an immediate catastrophic collapse. And so, a long answer to your short question there. The imbalances for the indebted countries inevitably are going to lead to a currency crisis of some sort, either immediate accelerating inflation or a collapse, or some combination of those two.
I support all your points, John, but what it leads to is malinvestments. And the magnitude of those malinvestments leads, in my mind, to at least four things. But one of his malinvestments, you've got cheap money. Therefore, you get artificially low cheap money, lowering the hurdle rates for businesses that shouldn't be in business, or shouldn't be invested. You're driven to speculation versus investment because the returns are so low on fixed instruments, as you were mentioning how ridiculously low they are. Also, it leads to leveraging, so that on low returns you can leverage that up and make a higher return using leverage. So all these malinvestments get in. You get mispricing that drives in because of currency distortions, whether it's currency wars or the competitive trade advantages we were talking about earlier. You get excessive debt, and then when you get excessive debt, you've got all of this issue with lack of growth. And our stimulus right now used to be $1 worth of stimulus would get you $3 or $4 worth of growth temporarily, maybe not sustained. Now, $1 worth of stimulus gets you 25 to 33 cents worth of growth. In other words, you don't get it back. And that's called debt saturation. You just get excesses all the way across the board. And we went into these extensively with peak everything and unsustainable expectations with Charles Hugh Smith. And just as an aside on all of those excesses, Bob Mahardy at 321 Gold wrote me a note, and he said, "Gord, you got all the peaks right, but you forgot the biggest one, peak government." And what that leads to, these excesses leads to bigger government, bigger control centralized control that we talked about at the beginnings. That's what all the kinds of things these imbalances, in my mind, lead to. What are the solutions, John?
There are no solutions. Yeah. No, when you borrow too much money, whether you're a country or an family or an individual, the same thing happens. You lose control over your life, and your life changes in really dramatically bad ways. And that's what's going to happen for us. We have two choices right now, and one is to collapse under the weight of all the debt we've taken on in the U.S. And the other is to try to inflate our way out and eventually destroy the value of the dollar and have a hyperinflation followed by a collapse, or at least an accelerating inflation followed by a collapse. And that's it. There's no way to grow our way out of this. There's no regulatory fix. There's no magic immigration policy or healthcare policy or perfect marginal tax rate or short-term interest rate. There's no policy fix anymore. So all we can do is deal with the consequences of our debt. And so at a macro level, you lose control of your life. And at an individual level, you have to think about what you want to invest in for this kind of a crisis. And, that usually comes down to the old fixtures: land and gold and food. and so we become survivalists in this kind of a scene. And I hate the idea that we have to talk about stuff like this, because, we didn't have to. 20 years ago, we could have chosen to manage our finances conservatively and to invest wisely and to plan for the future. And we didn't. We decided just to go for it, borrow as much as we could, buy as much as we could, and live big now. And now we're paying the price for it, and there is no solution. There's no way to get out of the hard times that are coming. We just have to make it through as individuals.
I've often said that wealth can only be created three ways. You either got to grow it, You got to build it, or you got to mine it. All of those get down to some kind of real assets. You can't print it. And because prints are just printing anything is nothing more than a claim on a debt or a claim on an asset that in fact can or may not be surrendered. So there's a question there. But I could argue, John, that the solutions to this are going to be end the U.S. dollar as a global reserve currency, the move away from a fiat currency based system because it, as we started with it, there's no parameters on how much the government can print. We need to establish a new Bretton Woods. The last time we had a crisis at the end of the Second World War was because of massive global imbalances, and we came up with new structures like the IMF, World Bank, U.S. dollar reserve status to solve these. And I think we need completely new set of structures. And having said this idealistic issue with what's wrong, there's no way it'll ever happen. Because why it needs to, the new realities is we have a global transfer from basically 2 billion people in the legacy developed world, their standard of living, to the 8 billion now in total around the world, 6 billion being in Asian emerging countries who are moving into the middle class and deserve and will expect a higher standard of living. That rebalancing is going to happen whether we want it or not. And why I'm a little negative is everything we are doing is aimed at trying to stop this rebalancing and the politically unpalatable standard of living adjustments that come with it. That has to happen. And so it's always been this way since mankind. We resist any kinds of dramatic changes, as blatant as they are, because of the status quo. And how it's always solved is there's a crisis, a massive crisis that forces realignments, whether people want it or not. So it's unfortunately, I personally am anticipating that it will take that. And I mean, I don't mean to be negative. The solutions are obvious, but nobody wants to even begin to address them. There's no political will.
No. We have to have the crisis before the status quo can be changed, and it'll be swept away by the market.
Right.
And then the discussion gets interesting because then there's the possibility of rebuilding something that works from the rubble. And, there's absolutely no guarantee that, the, free minds, free markets, limited government, sound money side of the argument wins in this. It's probably a lot more likely that, big government, enlightened despot kind of, mindset takes over at the bottom of the crisis. But at least it'll be possible to have that argument.
History bears out what you just said. What we can expect is a market clearing event, but unfortunately what comes out of the rubble becomes anybody with a strong idea and that people will rally around, and these people have not always led us in the right direction because they were waiting. And, it's out of those ashes that Hitler arose out of the chaos of the First World War. And I go through a history lesson here. So it'll be interesting to see, and it will be within our lifetime, John, exactly what kind of controls and who will end up with the control. And it may not be the ideal that we want. It'll be those with the biggest power.
No, we have to be there to make the argument. We have to try. But yeah, the odds are against a return to basic constitutional principles. but I'm still looking forward to the argument because there's a chance. Ron Paul educated enough people in the last 20 years that there is a core out there in the U.S. Who understands that the only viable kind of society is one based on free individuals following their own enlightened self-interest and protected by a government that is limited in its own power and that maintains a sound currency, all the rest. And if enough people get that, then there's a chance that we can go back to something like that. And so as long as there's a chance, we have to try.
There are days, John, where I can't believe just how brilliant our forefathers were when they wrote the Constitution. Just amazingly how enlightened they were. But they had their imbalances and their crisis of their day. And hopefully we'll have the same kind of far-seeing and value-driven people writing the next set of Constitution. We have to break for today, John. Unfortunately, this is a huge subject for us to talk about, and we'll continue in our ongoing series. Any final comments you'd like to make, and how our listeners could learn more about your writings and your website and more about the things you're doing?
Okay. Yeah. No final comments. I think we covered a lot of the things we should have talked about here. And I run dollarcollapse.com. That's a website that focuses on a lot of the things we've talked about here, the global imbalances and the investment strategies that might get you through intact.
Appreciate it, John, and we'll see you in a couple days because we're going to be back and we're going to talk about some of your latest writing. So I'm looking forward to that. Talk to you later.
Great. Thanks,
Bye.
Gordon.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.